about, first of all, confidence, and it's also about reducing some of the opportunities and the incentives for speculation. I've always believed that, for example, oil marketing, the large arbitrage opportunities between the domestic price for fuel and the price in neighboring countries provided an incentive for importers to basically purchase much more than we need domestically and smuggle it, either by berthing the ship in Cotonou and offloading, or bringing it in and then taking it out. And I think some of the changes in that market are going to lead to a dampening of demand from that side. There's also the fact that oil prices have remained firm. If you look at 2010, we lost 10 billion in reserves. In 2011, they were constant. Okay, so we've moved, while it looks like we haven't increased, we've actually moved positive 10 billion, okay, from a net position of minus 10 to zero. So we're gradually going into a process where we're having improved net savings in reserves. And since the beginning of the year, we've built up to 34 billion from 32, and it's continuing on a regular basis. We're trapping more of the oil revenues. We basically spending less, and therefore some of the speculative demand where people bet against the currency will begin to disappear. People don't feel the need and the urgency to purchase dollars now because they think there's going to be a depreciation. So and then of course we have also at the central bank, as you're aware, starting last quarter of the year, tightened controls and basically tried to make sure that we check sharp practices within the banking system. Those should help us, and our stance has always been clear. We're not a bank that is going for a fixed exchange rate, but we're committed to stability. And we're very transparent about it. When we wanted 150 plus or minus 3%, we had it. When we thought, given where the rates were and given where the demand was, we should move down, we moved. We are at 155 plus or minus 3%. Reserves are building up. We're under no pressure at all to devalue. If the reserves continue building up, we'll actually be in an opposite situation where we are resisting the pressure to revalue, because we think that we need to build buffers. At this moment, building reserves is more important than a stronger currency. People just want stability. So from the perspective of foreign investor, I think having a stable exchange rate with a range in which you can measure exchange rate risk, plus very high rates of interest, that's all he needs.
How prepared are Nigerian banks for the impending global economic slowdown? What are your thoughts on how prepared we are compared to 2009?
I think the banks are much better prepared today than they were in 2009. In 2009, they had huge exposures to a capital market that was already in a bubble, and those exposures have gone because they've taken those losses, and we've put in tight controls on margin lending. Exposure to the stock market is not much, and in any case, stock market is at the bottom, so there's no risk of a busting bubble. In 2009, they had huge unhedged exposures to oil marketers, and the lessons that they've learned from that means that at the moment, most of the oil marketing exposures are covered by product or by receivables. So in terms of the banks, the principal risk that we see can only come through two channels. And if there's a massive collapse in oil price, which is really a nightmare scenario, and that then affects government revenues, then that is likely to affect those banks that are dependent on public sector liability. So it is a balance sheet effect. We have dimensioned that. We know the banks that have public sector exposures. We've run stress tests. We have action plans to deal with that in the event of that happening. The foreign exchange positions that they're holding are not significantly risky. So even in the event of a depreciation of the currency, we're not going to see the kind of impact that we had in 2009 when the Naira crashed by 25%. So by and large, I think the banks are better prepared. And by and large, I think the economy itself is more vulnerable only because of the very low buffers that we have in terms of reserves. We're at over 50 billion when the last time happened. Now it's 30 billion. But I do think with the accretion we're having and with the news coming out of Europe and with what we know of the oil market, I do not see a major problem, but we are prepared.
Let's come back to the MPC decision today and talk to us about the risks for negative interest rates in Nigeria, especially now that we're expecting inflation to take up in the first and second quarter.
Well, the estimates of our staff suggest that inflation will range between 11 and 14.5% in the first 2 quarters. After that, it will come down. And we have looked at every single instance of fuel price increase. And what happens is that inflation goes up and then it goes down within a few months, okay, maybe 2-3 months. So there is a possibility that at some point the MPR result will be negative. But remember that today the yields anyway on long-term instruments are already in the 14-15% range. It will, the likelihood that those will turn negative is slim, but if they do, it'll be for a brief period. We expect after the end of the second quarter, inflation starts trending down, and we should be getting back to roughly where we are, about 10% or just below, by the end of 2013. So there is really no necessity for correcting MPR in response to what is a short-term explainable structural shock that will abate. Will we increase the rates during the year? It depends on other factors. It depends on whether the government decides to spend more, whether the National Assembly increases the benchmark for the budget. So if you've got monetary variables that seem to compound the inflation problem, we will respond. We will not have an accommodation for fiscal dominance. However, other than that, I think this is something that we can bring down without necessarily shocking the market more.